Okay, let's kick off. Good morning and welcome to Saxo's Monday morning client calls. This is a big week of Fed meeting and a flood of big tech earnings as well. So I'll start with the global macro picture first. Top focus this week, of course, being the Fed meeting. The consensus is now back to a second 75 basis points rate hike after initial battle between 75 or 100 basis points, following the high that we saw in US CPI this month. Some signs of cooling in the growth outlook, mostly from survey data, which actually at Saxo we don't trust quite a lot. But yeah, also looking at corporate commentaries, of course, there are signs of some cooling in the growth, as well as lower inflation expectations, which have collectively lowered the possibility of a 100 basis points rate hike. And the Fed officials have also come out more in support of a 75 basis points rate move for now. So that should bring the Fed rate to a range of 2.25 to 2.5%. This is a territory that is considered neutral, which means that the Fed is no more stimulating the economy. Why this is more important is because there are expectations that after the July hike, the Fed will likely slow down from here. This actually may be the last hike of this magnitude, and the Fed is likely to guide for smaller rate hikes from here as the policy becomes restrictive. But I think they will keep their options open. My sense is that there is potential for the Fed to surprise on the upside again, as markets are pricing in a terminal rate of 3.25 to 3.5%, while the June FOMC dots had implied a terminal rate of 3.75 to 4%. There will be no update to the dot plot this week, but Powell's presser will be highly watched for comments on the pace of hikes from here and any hints on the terminal rate front as well. What will also be important to watch is the US Q2 GDP this week. It comes out on Thursday. After a contraction in Q1, markets are highly focused on the sprint to decide whether to start calling out that US is in a recession or not. So far, expectations are of a small gain, about 0.5% annualized. But remember that the Atlanta Fed GDP Now model is predicting minus 1.6%. So, of course, there is still some potential for it to fall in the negative territory. Last week's big fall in July US Philly Fed survey, as well as a rise in initial jobless claims, is also dampening the Q3 GDP growth outlook. So overall, that does mean that the economic growth concerns will continue to linger this week as well. Possibly they will gather more pace with more data out, like consumer confidence, durable goods orders, and home sales from the US. Now, how to trade this growth inflation picture from the US? So some of the instruments I would look at is the dollar index, or the euro dollar, and the USD yen. Yen is particularly sensitive to moves in US Treasury yields, and so is gold. So, of course, keep those on your radar as well. Yield inversion could aggravate if Fed remains hawkish, as we expected to, while economic data continues to disappoint. Switching gears, Eurozone has been more interesting this past week, with the European Central Bank delivering its first rate hike in 11 years and exiting the negative interest rate regime. The 50 basis points hike was bigger than expected, but the anti-fragmentation tool that they've introduced, it appears to be a perfect black box. It has these 4 criteria for a country to be eligible, pertaining to some fiscal and macroeconomic policies, and of course, no European country could possibly fit the bill. So it does seem like Italy will be unable to meet those criteria, but it's all in ECB's hand, and they will offer the support to countries that they want to. The Russia gas situation has also somewhat sorted out, with Nord Stream 1 now flowing back at 40% capacity. But we did see new risks for the Eurozone last week, mostly on the political side, with the resignation of Italy's PM. So basically, energy crisis, political crisis, and limited tools at the hands of the ECB could mean continued pressures for the Eurozone into the winter, which would mean Eurodollar faces more downside risks as well. We also had PMIs released on Friday. So I think that was again interesting, because Eurozone was still the bigger concern, even though we did see weakness in US services PMI as well. But again, I think it's more interesting to watch them on a relative basis, and Eurozone certainly looks like a bigger concern than the US at this point. In terms of Japan, the Bank of Japan stayed pat with its ultra easy policy. Tokyo CPI did come in higher at 2.4%, still above the 2% target. So while while a BOJ pivot remains a low probability, it will still be a high impact event, and it's important to watch that for the rest of this year. So there's if the US yields top out, there is immense room for the USD yen to run lower. But at this point, again, like I said earlier, if the Fed remains more hawkish, there is still some potential for USD yen to go higher from the 136 levels that it dropped to on Friday. Coming to the commodities market, natural gas had a bull run, but also oil company ETFs are seeing some short sellers unwind some of the bets, which suggests that crude may be bottoming out temporarily. The key thing again to watch for the commodities now is the US dollar. If the Fed is again more hawkish than expected, USD could move higher, and that will again weigh on most commodities. So basically, to summarize this week, I'm watching a few key indicators that will be the reaction of the yields to the Fed policy, both high grade plus high yield bonds. Secondly, a spate of earnings is due. I think let me just summarize that as well here. Big tech earnings are on the radar this week. Key players like Alphabet, Apple, Amazon, Microsoft, Meta, all of them are reporting this week. So we will possibly hear of more cuts in spending and hiring plans. The reports will be also important to watch to understand the health of consumer demand, given that, of course, the macroeconomic environment is softening. I think for me, most important to watch would be Apple and Microsoft, because they have defied the downturn for now. And if they also do turn cautious on spending, Apple has already somewhat hinted on that. But if the details are more downbeat, the sentiment could potentially be hurt significantly from there. The other things that I'm watching, like I said, dollar and gold, as well as crude and energy markets. If the crude could join the natural gas in a new bull run, commodities will soar, while equities could suffer from there. That's it from me.
Good morning, everyone. In China, this week we have mainly two indicators. One is the industrial profit, but that usually is not really the focus of the market. The more important one will be the manufacturing PMI and the non-manufacturing PMI, but those will be coming out on Sunday, the 31st. And now economists are expecting that probably will be quite moderate and will be coming at around 50.3 is the market consensus for the manufacturing PMI. That's only a touch higher than last month at 50.2, and so still very close to the 50 threshold. So and then the non-manufacturing PMI is expected to came down a bit to 53.7, and from last month 54.7. So mainly is because I think the pickup in COVID-19 cases and restrictive measures, and also turmoil in those mortgage boycott situation in the property market probably are cited as some of the reason for economists expecting a rather subdued PMI, non-manufacturing PMI number. And as we mentioned, I think the market probably will continue to focus this week on those mortgage payment suspension or boycott, if you may say. And so far, there's more than 300 uncommitted buyers for those pre-sold properties from more than 300 uncompleted projects across 90 cities. Doing that, so the market is still quite concerned, but also I think analysts study looking at the impact, and probably even all those stalled projects probably accounts only 2.2% to 6% of the total mortgage loan outstanding, and in terms of total asset, probably is only above 0.3% to 1.4% of the leading those leading Chinese banks' total assets. So the scale of the problem probably manageable. It's not going to be a systemic risk to the Chinese banking system. However, it would definitely negatively impact the property market's sentiment, and potential property buyers, of course, become more hesitant or more cautious in buying a new home. And also, we will hurt the sentiment for stock and bonds of Chinese property company and also banks, because even though it's not a systemic problem, if some of those loans actually eventually turn out to be having to be written down, of course, that will hit the earnings of the banks. And also the government also will ask the bank probably, is to waive some of the mortgage payment or suspend, and also will hurt the banks. And another thing is from last week, Premier Li Keqiang in a meeting or in the special virtual dialogue with global business leaders, a World Economic Forum meeting. During the meeting, he said that China won't roll out massive stimulus, and he will not issue an excessive amount of money or withdraw the future for an overly high growth target. So he probably maybe pedal down a little bit on the 5.5% GDP growth target for this year. And so that will also actually that also will trigger more. Actually, economists has already been revising down GDP growth for China this year, and more towards the 3%, 3.5% kind of level from market economists. And also, analysts also have been revising down earning forecasts for 2022 and 2023 for Chinese company. And another thing to watch for this week is that Chinese Communist Party is holding the Politburo meeting this week, and the agenda will be top on the agenda will be the economic policy for the second half of the year. So the market will pay a lot of attention to the readouts or statement coming out from this meeting, and most focusing on any. But of course, it's there will not be major policy changes, but that would be, I think, looking for direction from what they say coming out of this meeting. And I think it's also market is expecting that right after the Politburo, and probably President Xi and other leaders, and we will go to the Beidaihe to have that informal meeting and joined by those retired party elders. That is very important. Usually that will be held in August, and that is actually to finalize the personnel and other arrangement for the National Party Congress that is due to be held in late October or November. The date has not been announced yet, and so depends what they come out from Beidaihe. And now the security measure in Beidaihe has already been tightened, and it's not a formal meeting, so that will not be formally announced. But that is believed that is all the leaders will gather there in early August. And basically the market will be bumpy, and also, but that we're expecting no major policies to be coming out in the coming weeks, and so only for looking for size, and given the worsened sentiment in the policy market and so on, and also the downward revision in GDP growth forecast and also earnings growth, and the market in Chinese stock market would be a little bit bumpy, and maybe the risk is more on the downside in the coming weeks. And that's all for me. Thank you. And Charles, you have anything to add or?
I think also probably just to watch Australia's inflation being reported this week will be likely to be the hottest since 90s. So that does give room to the Reserve Bank of Australia also to go for a jumbo hike. I mean, that could be 50 or 75 basis points. I think we are more inclined to say it would be 75 basis points, but they've avoided that last month as well. So probably just something to keep on their radar. And overall, 175 companies are reporting earnings this week. So this could be really a key week for the equity markets. If the earnings are better than expected, of course, expectations are going down. And if they do happen to surpass those expectations, the rally that we've been seeing in the equities could have some further room to run. I think that's it from me as well. And thank you for joining us today.
Yeah, thank you.
Yep. Talk to you again
Have
next
a good
Monday.
week trading. Yeah.
Yep. Bye-bye.